What if one US ultimatum could force global banks to pick sides, trade with China, or lose access to the world's most powerful currency and markets? Trump's orders now threaten to redraw the financial map, shaking alliances, business empires, and the delicate balance that keeps the global economy running. The new US financial ultimatum to global banks. In 2025, the US issued a significant financial ultimatum demanding global banks sever trade ties with China under the threat of losing access to the US dollar system and American markets. This aggressive move targets financial institutions worldwide, extending US influence far beyond its borders. By leveraging control over the dollar clearing system and payment networks like SWIFT, the U.S. Treasury pressures banks to comply or face exclusion from critical financial infrastructure. This ultimatum comes amid escalating geopolitical tensions and signifies a sharpening of economic warfare strategies. It signals Washington's intent to isolate economic competitors while provoking new global financial realignments. The world now faces a stark choice: adhere to U.S. demands and risk fracturing vital trade connections, or resist and potentially lose dollar-based access. The Trump administration's trade and sanction strategy. The Trump administration's 2025 strategy intensified its use of tariffs, sanctions, and trade restrictions as tools to address perceived economic imbalances and national security concerns. Following earlier tariff escalations, the administration moved towards a broad reciprocal tariff system, imposing punitive duties on imports, particularly targeting China, to drive down the bilateral trade deficit. Sanctions expanded beyond traditional embargoes to include extraterritorial demands on global banks and companies engaging with sanctioned nations like Iran and Russia. These measures aim to weaponize America's dominant financial role to coerce compliance and reshape global trade relations. However, rising tariff rates reaching over 100% on Chinese goods created economic uncertainty and choked supply chains, while the tax policy proposed higher corporate taxes on foreign firms, undermining foreign direct investment. The U.S. Treasury's April 2025 warning to Hong Kong banks. In April 2025, the U.S. Treasury conducted covert meetings with major Hong Kong-based banks, including HSBC and Bank of China, issuing a stern warning regarding their involvement in Iranian oil transactions paid in Chinese yuan. The Treasury signaled that financial institutions facilitating these trades risk losing access to U.S. financial infrastructure, including the SWIFT network and dollar clearing services. This marked a sharp escalation in extraterritorial sanctions, compelling foreign banks to enforce U.S. policies outside American jurisdiction. Shortly after, sanctions targeted 9 Hong Kong entities alleged to launder Iranian oil revenues using falsified shipping documents. The warning emphasized the U.S. goal to disrupt non-dollar trade loops circumventing American influence, forcing banks into difficult compliance decisions. It also demonstrated the U.S. intent to control not just domestic actors, but global financial intermediaries, intensifying tensions and raising concerns about unilateral global financial enforcement, targeting Chinese yuan oil trades with Iran. The U.S. Treasury's sanctions strategy focuses tightly on the burgeoning oil trade between China and Iran, which often bypasses the dollar by settling transactions in the Chinese yuan. China is Iran's largest oil importer, acquiring more than 1 million barrels daily under a strategic 2021 cooperation agreement featuring discounted pricing and long-term contracts settled exclusively in yuan. By targeting this trade, the U.S. aims to choke a critical source of Iranian revenue and challenge China's growing financial influence. The move risks disrupting a rapidly expanding non-dollar payment ecosystem and threatens banks that facilitate these oil flows with severe financial penalties. This focus reveals Washington's broader goal: to prevent alternative currency arrangements that could erode the dollar's global dominance. The sanctions push China and Iran closer into a strategic economic alliance that challenges Washington's control over international trade and finance. Losing access to the U.S. dollar financial system. Banks and companies caught engaging in sanctioned transactions risk complete exclusion from the U.S. dollar financial system, the world's primary currency and payment hub. Losing access means forfeiting the ability to perform dollar-denominated transactions through global networks like SWIFT or dollar clearinghouses, effectively cutting them off from vast parts of the international economy. This threatens their liquidity, cross-border business, and relationships with U.S. financial institutions. The US uses this power as a weapon to enforce sanctions extraterritorially, compelling adherence far beyond US soil. However, this coercive approach accelerates efforts by other global powers, especially China, to build alternative payment systems and digital currencies that bypass the dollar. In the medium term, such exclusion risks fracturing the existing global financial order, undermining US leverage, and encouraging the rise of multipolar financial systems with competing currencies and rules. Sanctions on Hong Kong entities linked to Iran's Revolutionary Guard. In July 2025, the US Treasury sanctioned 22 entities based in Hong Kong for facilitating Iranian oil sales benefiting the Islamic Revolutionary Guard Corps Quds Force, also known as IRGC-QF, a designated foreign terrorist organization. These companies, often front firms, used falsified documents and offshore accounts to launder revenues that finance Iran's nuclear and missile programs. The sanctions disrupt a shadow banking network that moves hundreds of millions of dollars for the IRGC-QF, undermining regional security. Treasury Secretary Scott Bessent emphasized that the regime's shadow banking is not aiding the Iranian people, but fuels destabilizing activities. The operation revealed the extent of Iran's clandestine financial infrastructure, extending into Hong Kong, Turkey, and the UAE. By targeting this network, the US aims to cut off vital funding sources for the IRGC-QF and pressure Hong Kong banks to cease complicity in these illicit schemes. This crackdown intensifies US efforts to enforce sanctions extraterritorially and block Iran's access to global financial markets. Importing Iranian oil paid in yuan, not dollars. China imports over 1 million barrels of Iranian oil daily, accounting for approximately 91% of Iran's exports. Crucially, these transactions are settled primarily in Chinese yuan rather than US dollars, representing a strategic bypass of dollar-based financial channels. This arrangement rests on a 2021 China-Iran cooperation agreement that secures Iranian oil at a 12% discount with an additional risk premium. By using yuan-denominated payments and long-term contracts, China strengthens its financial independence from dollar dominance and deepens its geopolitical alliance with Iran. This yuan-based trade loop challenges the traditional US-led financial order by expanding non-dollar settlements. The arrangement benefits Iran by providing a reliable market for oil despite US sanctions and benefits China by positioning the yuan as a more prominent global currency in energy markets. The trade's growth is prompting Washington to target Chinese payment systems and banking partners involved in these transactions to preserve the dollar's primacy. The dollar's challenge. Non-dollar trade loops, particularly those involving Chinese yuan payments for Iranian oil, represent a growing challenge to the US dollar's long-standing global dominance. These alternative currency corridors enable countries to circumvent dollar-based sanctions and reduce dependence on US financial infrastructure, including the SWIFT network and dollar clearing systems. By 2025, cross-border yuan settlements in Hong Kong surpassed dollar transactions, reaching over $260 billion, symbolizing a significant shift toward a multipolar currency world. This development accelerates as nations seek financial resilience amid escalating US sanctions. Non-dollar loops also provide strategic autonomy to countries like China and Iran, facilitating trade without US oversight. Washington's sanctions have paradoxically incentivized the expansion of these systems, including the use of China's central bank digital currency to bypass dollar intermediaries. The proliferation of such trade loops risks fragmenting the global financial order and weakening US leverage in international economic affairs. The extraterritorial reach of US financial demands. The April 2025 directive from the US Treasury extended its sanction enforcement far beyond American borders by pressuring foreign banks, including those in Hong Kong, to comply with US policies or face exclusion from the dollar financial system. This extraterritorial application compels non-US institutions to act as enforcers of Washington's sanction regimes, such as restricting Iran-China yuan-based oil transactions. By threatening access to SWIFT and dollar clearing facilities, the Treasury blurs the line between sovereign regulation and coercive financial diplomacy. Critics argue this approach challenges international financial sovereignty by imposing unilateral US rules on global actors without international agreement. The policy aims to maximize pressure on sanctioned countries, but risks diplomatic backlash and encourages targeted countries to develop alternative payment networks and foreign exchange systems beyond US control, contributing to geopolitical and financial fragmentation. Banking compliance pressure. Prominent Hong Kong banks, including HSBC and Bank of China, received direct warnings from US Treasury officials to identify and halt transactions connected to Iranian oil trades, especially those conducted in Yuan or other non-dollar currencies. These banks operate at the intersection of significant geopolitical tension, pressured to act as compliance agents for US sanctions despite their operations outside US jurisdiction. The Treasury emphasized scrutiny of ultimate beneficial ownership to prevent circumvention through front companies and shell entities. Failure to comply risks sanctions that could deny these banks access to critical dollar clearing systems, which underpin their global financial services. This places financial institutions in a precarious position of balancing US demands with regional and political realities. The compliance pressure also highlights the increasing politicization of global banking and underscores the challenges of navigating competing spheres of influence in international finance. China's expanding Yuan cross-border settlements in Hong Kong. China's Yuan cross-border settlements in Hong Kong have surged significantly, marking a strategic milestone in global finance. In early 2025, yuan-denominated transactions in Hong Kong exceeded dollar settlements for the first time, with volumes surpassing $260 billion. This trend reflects Beijing's efforts to internationalize the yuan by linking mainland China's internet banking payment system with Hong Kong's faster payment system, enabling faster, cheaper, and more efficient cross-border transfers in renminbi. The People's Bank of China and Hong Kong Monetary Authority jointly launched the Cross-Border Payment Connect, facilitating mobile and online banking remittances between the regions. This integration deepens financial connectivity, supporting trade and economic activities within the Guangdong-Hong Kong-Macau Greater Bay Area. By lowering transaction costs and increasing transaction speed, China strengthens Hong Kong's role as a financial center and promotes yuan usage internationally. These developments enhance yuan's appeal amid geopolitical tensions and US sanctions that challenge dollar dominance. The Strategic China-Iran Oil Cooperation Agreement. The 2021 China-Iran Oil Cooperation Agreement is a cornerstone of Beijing's strategy to cement long-term energy security while bypassing the US-led financial order. Under this deal, China imports over 1 million barrels daily from Iran, representing more than 90% of Iran's oil exports. The agreement secures oil supplies at approximately 12% below market price, with an additional risk premium factoring in geopolitical uncertainties. Uniquely, all transactions are settled in Chinese yuan, sidestepping US dollar-based sanctions. This arrangement enhances China's leverage in global energy markets and enables Iran to sustain crucial revenue despite enduring heavy US sanctions. The non-dollar denomination deepens China's financial independence and challenges the dollar's hegemony, empowering a growing financial alliance between the two countries. This pact represents not only an economic bond, but also a political alliance aimed at resisting US economic pressure and fostering an alternative trade system grounded in yuan currency usage. US sanctions versus China's financial and strategic countermoves. US sanctions targeting China's financial interactions, especially those involving Iranian oil transactions, are being met with robust Chinese countermeasures designed to protect and expand its alternative financial architecture. Beijing has adopted aggressive policies encouraging state-owned enterprises and banks to prioritize yuan-denominated settlements, strengthen cross-border interbank payment networks, and develop blockchain-enabled clearing systems. The People's Bank of China has accelerated pilot programs for its central bank digital currency, promoting its use in foreign trade, notably with Southeast Asian partners. These initiatives circumvent traditional US-controlled payment systems like SWIFT and the dollar clearing network, diminishing US sanction effectiveness. By reinforcing these parallel systems, China mitigates geopolitical risks and furthers de-dollarization. This financial resistance demonstrates an evolving multipolar global economy, where the US financial dominance faces unprecedented challenges and alternatives gain momentum amid escalating trade and sanction conflicts. Growth of renminbi usage in global payments and trade. Renminbi usage in global payments and trade has attained unprecedented heights in 2025, signaling fundamental shifts in international finance. As of March 2025, over 54% of China's cross-border transactions were conducted in yuan, totaling roughly $725 billion. This surge results from proactive measures by the People's Bank of China and government mandates, encouraging yuan payment preference among state firms and commercial banks. The cross-border interbank payment system supports over 1,400 institutions across 119 countries, handling trillions of yuan annually, positioning the yuan among the top global currencies in trade settlement. Expanding yuan trade corridors facilitate bypassing dollar-centric systems, providing countries under U.S. sanctions avenues to engage in international commerce. Increasing renminbi integration into global financial infrastructure advances China's strategic vision for currency globalization, challenging U.S. dollar supremacy by embedding yuan as a trusted alternative in the multilateral economic system. Impact on U.S. economy. The U.S. economy in 2025 exhibits troubling signs amid sustained inflationary pressures and weakened consumer confidence, impacting business profitability and growth outlooks. Consumer sentiment dropped to near historic lows, with inflation expectations reaching levels unseen since the early 1980s. Retail and wholesale profit margins contracted significantly as companies absorbed rising costs instead of passing them fully to consumers, squeezing earnings. Steel import prices surged over 25% year-over-year, while reports noted 15 of the last 17 months marked declining retail profits. These fiscal challenges are compounded by trade uncertainties from fluctuating tariffs and regulatory volatility, creating a cautious investment environment. Such economic headwinds jeopardize reshoring initiatives dependent on strong domestic demand, impeding long-term industrial expansion. Persistently weak margins and inflation hinder corporate pricing power and consumer spending, signaling deeper structural challenges that may limit the effectiveness of trade policies aimed at revitalizing American manufacturing competitiveness. Proposed U.S. tax measures and their effects on foreign investment. New U.S. tax proposals aim to impose retaliatory measures against countries perceived to treat American firms unfairly. These include a 5 percentage point hike on foreign companies' U.S.-sourced income taxes and increased withholding rates on outbound payments. The Tax Foundation warns this could cut foreign direct investment by up to $91 billion annually. Higher tax burdens and unpredictability create an uncertain environment that deters multinational corporations from expanding or reshoring operations in the U.S., potentially undermining economic growth and job creation. The measures risk reversing efforts to position America as an attractive destination for global capital. Volatility of U.S.-China tariffs and trade talks in 2025. U.S.-China trade relations in 2025 have been marked by extreme tariff fluctuations, swinging from 10% to 30% within months. This unpredictable policy environment disrupts supply chains, inflates costs, and fuels market uncertainty. Frequent renegotiations and inconsistent enforcement create a chaos premium, causing manufacturers and retailers to delay investment and inventory decisions. The inconsistent tariff landscape undermines business confidence and hampers long-term planning, weakening prospects for stable trade relations and economic growth. The risk of global financial system fragmentation. Aggressive U.S. sanctions and extraterritorial demands are accelerating fractures in the global financial system. By coercing foreign banks and nations to conform to unilateral rules, the U.S. risks pushing affected countries to develop independent payment systems, bypassing the dollar. This fragmentation threatens the uniformity and efficiency of international transactions, leading to competing currency blocks and fragmented capital flows. The splintering of the dollar-centric order may reduce American influence and create a less predictable global financial environment. China's central bank digital currency as a dollar alternative. China's CBDC initiative is rapidly gaining traction as a strategic tool to reduce dependency on the US dollar. By integrating digital yuan payments in regional trade, particularly with Southeast Asia, China facilitates faster, cheaper, and more secure cross-border transactions without reliance on traditional dollar clearing systems. The CBDC supports Beijing's broader goal of internationalizing the yuan and building a parallel financial ecosystem, undermining dollar dominance and offering nations an alternative in a fragmented global economy. The future of dollar dominance and global trade dynamics. The dollar's primacy faces growing challenges from evolving geopolitical conflicts, alternative currency systems, and shifting trade alliances. U.S. financial coercion may accelerate the development of non-dollar networks, diminishing American leverage in global markets. The future likely entails a multipolar currency environment where power balances depend on economic strategies and political alliances. Global trade dynamics will increasingly be shaped by competing financial architectures, with uncertainty around which currency or system will become the new standard. As U.S.-China tensions redefine the global order, one thing is clear: today's financial decisions set the course for tomorrow's world. Will banks submit or resist, and who will really hold the power? Let us know your thoughts below, and if you want deeper insights, be sure to subscribe for more.